Welcome to this week's Desk Side Chat. Very interesting topic this week. We're going to hopefully get into or start off a lively debate inside our community for the week. With this Desk Side Chat, we have two guests joining us, Cody Garrett and Drew Stotler. Gentlemen, if you wouldn't mind, we'll start with you, Cody, if you could give a little brief background on yourself, and then we'll head over to Drew.
Sure. So I was a professional musician for 10 years, career changer. I changed careers in 2018. I kind of went backwards in terms of kind of what people expect you to do in terms of joining the industry. The first thing I did is I enrolled in a CFP education program as a professional musician. About 3 classes in, I said, hey, I think I actually want to do this, help people align their money with their values in terms of comprehensive financial planning. So I joined an independent fee-only RIA that offered 3 services, household wealth management with an AUM model, 401k administration, and flat fee financial planning, like project-based plans. So I joined the industry, was drinking out of the fire hose. I passed the CFP exam before I had my 65. So I took the CFP, then I took my 65. So I felt like, wow, the 65, like a caveman could do this after the difficulty of the CFP. It's funny. I got my insurance license, like life and health. Never used it. I just got it because I wanted to just get some more education in that place. Actually, the RIA also had a broker dealer. They dropped it once. Actually, this is kind of a big part of my story. Is about 9 months in of working at that firm, one of the partners, who was the lead financial planner, left to join another firm. She was the only one who sold insurance and annuities and stuff. So they dropped the broker dealer when she left. But when she left after 9 months of me being there, they said, well, Cody, you're now the lead planner. And at that point, so passed the CFP, got my 65, didn't have my CFP designation because I only had 9 months of experience at that point. But I just became the lead financial planner at that point. I worked there for 2.5 years. And then I left to launch my own firm, June of last year of 2021. The reason I left, this is kind of comes into the debate today, is I received a call from a gentleman who said, I have interviewed, first of all, he was really frustrated when he called me. He said, I have interviewed 10 fee-only CFPs, and none of them will provide financial planning without an expectation to manage my money. And I said, oh, well, that sucks. But what's good is I can offer you a project-based financial planning, without managing your money and without, the obligation expectation too. He's like, great. So he went through that process. Within a month, I received like over a dozen of those messages from other people. And once he realized what I did, he kind of shared it among his groups and things. So by January and February of 2021, I brought on $48,000 worth of planning fees. So in those 2 months, and I realized, wait a minute, I get paid $50,000 a year, $55,000 a year, but I just brought on $48,000 worth of planning fees in 2 months. Like, maybe I could do this on my own. So I launched a firm specifically without managing any client assets. So I'm saying I'm only going to provide comprehensive financial planning, flat fee, of course, right? Not based on assets, not based on income. Every household pays the same fee for the same service and process. I wanted to niche down to exactly knowing who and how I served. And then the third part of that we'll talk about is how I decided to charge. So I've owned my firm for a year. I have 45 people on my waiting list, 45 households on my waiting list. I refer away about 20 clients per week. So when people tell me that advice-only financial planning, which is fee-only financial planning without the expectation, obligation, or even the option to manage client investments, they tell me it's not sustainable, it's not scalable, it's not profitable. But again, I'm actually referring away about $6 million in annualized revenue right now because of the demand for advice-only financial planning. So That's how I got here.
Well, welcome. Appreciate you jumping in. Drew, quick background on yourself, and then we'll jump into this.
Yeah, I've been in the financial industry for about 20 years in a couple different roles. Prior to becoming an advisor, I was in anti-money laundering. So I was watching money moving from advisor to advisor or client to advisor and investigating things like that. And that's how I learned about the financial advisor role and thought that was more along my skill set as far as creative planning and just kind of working with people on a service-based engagement rather than corporate. So I transitioned out to the field, spent about 8 years with a very large broker dealer, especially here in the Midwest. Outgrew them. I got tired of being told, no, you can't, put your spin on this. You can't put your spin on that. So I decided to branch out and plant my own flag in the ground right in the middle of COVID, April of 2020, which kind of sucked for transitioning, but I am now on the independent channel. And that's kind of me in a nutshell. So it's been just over 2 years going strong, and I'm really glad I made the switch. Wish I would have done it 8 years earlier.
Well, speaking of switch, now Cody made a pretty strong argument there, Drew. What it's kind of hard to challenge those numbers. Are you ready to jump in and go straight to fee for service, Drew?
Yeah.
After what Cody said.
Yeah. Right.
That's it. All right, debate's over. We're all good.
Yep. See you later.
But seriously, I mean, what are your thoughts around how you're currently compensated, your current model, Drew, in comparison to what Cody laid out earlier?
So given my start, where I started from, it was more old school. Like you literally got out and knocked on doors to build your business. And with that came more of that brokerage mentality. I quickly realized, months, a couple years in, like this is not sustainable for me as a person. Like I just felt icky calling and making kind of sales calls. And so I started calling on appointments. Hey, I got a great investment here paying a 3% dividend, but when's the last time you sat down and put all of the pieces of the puzzle together? So around year 2, I started to shift away from commission-based business. But I had a good chunk of it on the books already. So I, right now in the model today, I'm about 82% fee-based and about 18% brokerage or commission-based, including some off-book assets like 529, A-share 529s and things like that. I'm shifting to fee only. It's just, I've got some kind of grandfathered clients on the books that, we're just kind of talking through that and what's the best way to unwind that. But I don't know if I'll ever drop my insurance license. I am pretty much agnostic. I don't go out with an agenda to sell insurance, but if I see a hole in somebody's plan and I know they're not going to go get it themselves, I like to tee it up and kind of make it easy for them with a few options. I definitely don't push it per se, but yeah, as far as like commissionable investments, I don't offer it anymore. I still have some on the books though. Does that make sense?
Yeah. Well, back over to Cody. So as you're referring out that business, to Drew's point, you're trying to get a client to buy in, or whether it be insurance or whether it be other services, you're building that plan, you're helping that client. I guess in your case, you're referring out if it's just not a relationship, right? It's just somebody.
Well, right now I'm referring out primarily because of I've deliberately limited my capacity to 10 hours a week, which is 2 clients a month.
Okay. And for those clients you're working with though, they have, different needs and so forth. So how are you accommodating those if you're not offering them directly, or following up and making sure that the client follows through on your recommendations?
So I have a 3-month process. It's a 3-month 3-meeting process. So within the first 2 months, that's the deliver. So just going through those 3 meetings. So there's an introductory meeting, which is really there. So the service, process, and fee are all on my website. So I don't want to spend any time with a client talking about transactional sales, right? Which is service, process, fees. I want to focus on their family and start creating the expectation of a collaborative relationship and an educational approach to financial planning. So the first meeting is all about learning about the client and really mutually defining the expectations of financial planning, along with their kind of their 50,000 foot view, like objectives and values as a family. After that, they pay, if they want to move forward, agreement, they pay half the fee up front, $3,200 up front. Then we start data gathering. So they upload their data to eMoney, including aggregating accounts, things like that. I typically review 40 to 50 documents per client. I look at everything in their life with a number on it, as I call it. The second meeting is when we verify the accuracy of that information I've summarized. and then dive deeper into their qualitative objectives, values, desired outcomes as a family. The third meeting is a plan presentation, where I typically provide about 25 topic areas. Since my approach is, again, the only service I provide is education, which I talk about as providing the clarity and confidence to move forward. And I do believe that DIY investors can successfully manage their own money, which is something that the industry has that's the biggest defense the industry has, is like people will inevitably fail if they don't have an advisor. So I don't just tell them what to do. I certainly don't do it for them. I don't just tell them what to do, but they know what to do, how to do it, and most importantly, why they're doing it in alignment with their own values and objectives. So that plan presentation is very educational. So again, it's not just saying like, hey, go do this. And the thing is, when they know how to do it and why they're doing it, they're much more likely to actually stick with that education. But the big part too is that plan presentation call is within 2 months of the 3-month engagement. So the whole third month, there's a big misconception about what I do. People go, well, how do people actually do it if you don't offer any ongoing implementation? And that third month, like I screen share with them. We make trades like literally live together. Like, I'll jump on the phone if they need to talk about, get transfers done. I connect them with, so what's great about insurance, right? I do believe in the power of insurance as a powerful tool. What is nice about not selling it is that when I do advise insurance, they're much more like, at least from my perspective, I deal with the anti-advisor communities, kind of the DIY investors, who they're very at least they're coming from a place of being very anti-insurance, anti-anything really, sales. But I provide, when I tell them, hey, I noticed there's a gap in like long-term disability or life insurance, like they're like, since they know I don't get paid for giving that recommendation, they're like, okay, well, if he's saying to do it and he doesn't get paid for it, it must be like legitimately what I need. So I connect them directly. So I still facilitate all those relationships with other professionals. It's just that I don't do any, like, I'm just not the one clicking the buttons. That's what they're doing. So does that help answer that a little bit?
Yeah, no, that's good. And then on an ongoing basis, so that 3-month process. So are you done after that, or is a client able to continue to engage, reassess after a year, or how does that process work after that 3 months?
Yeah, that's right. So I charge $6,400 for the first 3-month process, which is truly comprehensive, getting to know, again, their qualitative financial ecosystem and their qualitative values and objectives. Really, first of all, I separate. This is a big thing that the traditional industry doesn't quite get, is I separate financial planning from implementation. I view them as completely separate services that should be charged. I guess if I were to talk about a debate, I believe that financial planning and investment management should be separate services charged separately. So I actually view investment management as a product, just like I view insurance or estate planning. I view investment management as really as an implementation service, not a financial planning service. So go back to your question. So I just went down a little rabbit hole there.
No, you're fine. So ongoing after that initial engagement, what does that look like in your case?
Right. So they do a 3-month comprehensive engagement for $6,400. The big misconception about what I do is some advisors would call it the one-time financial plan. But the misconception about a one-time financial plan is it doesn't just have to happen once. So over 4 out of 5 clients that I work with want to have an annual engagement. So they want to do this comprehensive financial planning process once a year to do that. Like, am I on track? But the reason I don't do monthly is because it actually goes back to what we'll talk about a little bit more, is who I serve. I serve disciplined DIY investors who have the time, the temperament, and the talent to implement their own decisions, which means they don't usually need like monthly handholding like along the way. Like they check in, they kind of get their list of things that like are mutually defined, what I call a measurable action plan, the MAP. Which kind of here's all the things that need to be done within the next year. They get all those things done, right? They can check in, certainly they can email me. It's not like I just completely kick them out the door, but they usually check in once a year and say, okay, like let's refresh, let's make sure, are we still on track? Are there new things that we should be taking advantage of this year? So so most clients want to work together annually or less often, which is typically especially crossroads, like they say, hey, I want to retire in 5 years. So I'm going to do a comprehensive plan today to figure out what are some things I should start implementing as I prepare for retirement. But then I'm going to check in Cody. I'm going to check in with Cody a year before I retire. I'm going to check in with Cody the year I retire and then the year after, so that I can help them through that transition in terms of being a guide, right? Kind of like building a story brand, like being a guide, but not the hero of the story. I'm there when they need me, but they don't need to pay like the gym membership if they're not going to the gym every month.
Drew, what does your client engagement experience look like?
Well, I think one thing Cody just nailed on the head is who we serve. Like, so traditionally, I've been more of that baby boomer demographic. I've gone out more and gathered assets. And I'm at this inflection point to where, of course, I'm not just going to disengage with those relationships. You know, I took them on. I'm going to continue to serve them. But, you know, going forward, I've had more people just come in over the last 12 months that are those DIY types that value professional advice, that are comfortable going to execute their own trades. And so I'm seeing a shift here. Cody, I'm not sure exactly where you're from, but I'm in the Midwest in Missouri. And I think that's an indication. You know, stuff always happens slower here. Whatever's going on in California was like 10 years ago for us here in Missouri. You know, it's like,
yeah,
TikTok and all that crap is making it faster, but
yeah. Well, I'm the only person I know in all of Houston. What is that, like the 4th or 5th largest city in the nation? I'm the only person in this city that does what I do.
Yeah. Okay. Yeah. So I think he represents a very up and coming trend in this whole industry, even as the younger people age up, but even as some of those baby boomers. I've actually encouraged a couple of my clients to transfer their assets off book because they're not trading, you know, they're in an account paying an ongoing fee. I'm like, look, you know, you could do this at like a Charles Schwab or somewhere like that and save several $1,000s a year and just pay me the fee for planning. So and some clients have still been reluctant to do that. Even I'm like, you really should, you know, it's literally going to save you like $4,000 a year. So, you know, I'm at this weird inflection point again, because historically it's been more, even back at that other broker dealer, it was still more AUM business, you know, for a fee. But again, with all the regulatory crap, if nothing else, if you just looked at that aspect of it, it's just not worth keeping those commissionable assets anymore, to an extent. Now, the one caveat I would say is, you know, sometimes I'll come across a prospect that has money in a fee-based account and, you know, I'll ask about their trading activity. You know, how often do you trade? Oh, you know, not much, like in once a year. Oh, a few years ago we did something. Okay, well, you know, you're paying 1.5% at least if there's not some other internal expenses. And so I'll educate them a little bit around, because I had a lot of advisors on LinkedIn that were railing against A-share business. And part of that reason is there is an inherent conflict of interest, right? Typically, you're going to pay a sales load anywhere from 1 to 5.75%. But if you look at the internal expense ratio compared to some of these other funds, some of these other prospects that I'm meeting with, I'm like, you're not really getting the value. So I think a lot of it is who you serve. And a lot of it is just being upfront and transparent with all of the costs, right? So I've trained 250, 300 different advisors, and I've listened to a lot of these sales calls, and a lot of them are left a little bit short. Like, oh, it's, you know, 3% or it's 1% a year. Well, what, you know, there's really more to it than that. There could be transactional charges or internal expenses. There's a lot that goes into. So Cody hit it on the head. I think it's who you serve. And again, more where I'm at least, traditionally it's still ongoing. The people in my circle, typically in that baby boomer demographic, they want somebody to just do it for them. I'm not saying that won't change, but at least where I'm at and the referrals that I get, they're more of the delegators, you know, so that's where I'm a little bit different. But so
the biggest thing that I kind of go back to, you know, if we want to make this like a debate, a boxing match, like one of the biggest issues in the industry is that
it will be, because I'm going to bring in some other people that are going to, you know, so it will be. Don't worry.
I got you. So
this is the nice part, Cody. This is where it's nice and gentle.
Yeah, this is the gentle part.
Yeah.
So one thing that I find is that, so first of all, I do want to back up here a little bit and say that so a lot of people think advice only is a fee model right? Like AUM. So AUM, so when somebody says they're an AUM advisor, to me, that's a fee model, not a service model. So all AUM tells me is how they charge. It doesn't tell me what they do, right? Advice only actually doesn't say how I charge. So you can charge advice only. You can charge an hourly, project-based, ongoing retainer. So like there are fee models within advice only, which so the service model that, again, advice only specifically shows that I have, like, the only thing I do is educate clients on how to make well-informed decisions. Whereas AUM, when somebody says they're AUM, so I just kind of put a note here. I said, when you tell somebody that you're an AUM advisor, that only tells them, in terms of service, all it tells them is that you're an investment manager. It doesn't tell you that they're a financial planner. And another thing is that, so fee models communicate how you charge, service models communicate what you do. But the biggest issue I have, if I were to, like, rail on like AUM for a minute, it communicates that the value of, if you only charge an AUM fee, like let's assume that you actually do real financial planning, right? You do financial planning, investment management. Again, you can't really, I would say you can't manage somebody's investments in their best interest unless you actually know their interest. So that means doing comprehensive financial planning. But if you charge for financial planning plus investment management with an AUM fee, you are communicating to the public that the value of financial planning is perfectly correlated with the stock and bond markets. So I just looked at, for example, the American Balanced Fund, like a 60-40 portfolio. This quarter, or like, year to date, there's AUM advisors who are providing a great value through like comprehensive financial planning. And they have just communicated to their client that the value of their services has dropped 10% year to date, because that's how they charge. Right. So if we talk, the biggest issue I see is people say, oh, well, it's all about, like, they talk about value. If you're trying to correlate value with how you charge, then AUM is not it. In terms of, not just the stock market goes down 20%. Like, should you get paid 20% less as an advisor? I don't think so. If somebody takes out 20% of their portfolio to buy a house, should you get paid less? So I'm actually flipping the switch. A lot of people say it's the opposite direction. There's like the conflict of interest, that, oh, well, there's a conflict of interest as an AUM advisor, that if someone wants to buy a house, like, no, keep those assets in house, or, don't buy that annuity, keep them under management, go into the stock market. But on the flip side, right, like, is it fair to the advisor, right, if the amount of money in the account somehow dictates the value of what they do in terms of service, in terms of financial planning? I would say most financial advisors are probably providing more value year to date than they were when the stock market was up. So for me, it's ultimately about a disconnect in what we do and how we charge. And fee models, regardless of which one, commission, AUM, flat fee, whatever, it doesn't communicate anything about what we do to the public. It actually just makes the public just think, again, that ultimately all we care about is charging rent on their money.
Drew, any thoughts on that?
No, I agree with that, because again, I didn't come from that world, so I've had to relearn it, because there's been so many Henrys, high earners, not rich yet. There's been so many Henrys that, I guess legally I probably can't say have to had turned away, but I felt like I had to turn away because they didn't have $100,000, $200,000. So and again, this is a learning experience as I go over the last 2 years, but now I'm charging a separate fee for planning for that very reason, because live by performance, die by performance. It's a portion of what I do. And that's why I'll tell people up front, like, my job is not to make you money, it's to keep you from going broke and make sure the plan is durable enough to last the rest of your life. So yeah, no, I do tend to agree with that.
Well, and don't worry, Cody, we're going to get some people that are going to give you some business here at some point. But with in your case, so back to you, Cody, not everybody is going to you buy into this model. Like you said, you're looking for the do-it-yourself investor, somebody
Right.
who maybe is generally has looked at advisors in a certain frame of light. So when you do come across somebody who isn't a fit, for what you're doing, or they have a different mindset, is that the business that you're referring away? Or how does that conversation go when you find somebody who's expecting you to do everything for them? potentially?
Yeah, it's a great question. So yeah, you bring up a great point that there's a whole spectrum of, so if there's the spectrum from like left to right, like left is being like DIY investors who are literally, they have what I call the time, the temperament, and the talent to manage their own money. And then on the flip side, there's the delegators. Those are the ones that come into your office and say, just do it for me. Which, we can go deeper into like what that really psychologically means when somebody says the word just, when they talk about just do this for me, in terms of like the frustration, and they've kind of given up on the idea of having time, temperament, and talent. But sorry, again, I lost your question. I was gonna. So if somebody comes to me, a lot of people go, well, what happens if somebody comes to you and like you find out they're like, they actually need somebody to help them with ongoing implementation, like they are a delegator, not a DIYer. And so I refer DIY investors who can do it, who are on the DIY part of the spectrum. I refer them to other advice-only financial planners who don't have the expectation, obligation, or even the option to manage any client investments, because they specifically don't want that. They don't want the recommendation for what to do with their investments in the financial plan to be, oh, my recommendation for the financial plan is to, for the investments is to have me do it for you. Like that's not what they want to end up with in terms of the recommendation there. On the flip side, if they come to me and they say, hey, yeah, I'm really looking for somebody to help me manage my money. Like I say, what do you, are you looking for ongoing or one time? And they say, I want ongoing, and I'm willing to have somebody else manage my money. I refer them to a flat fee. I refer them to a flat fee financial planner, with investment management. So I only refer to other flat fee advisors, whether it's advice only without investment management or flat fee with investment management. And what I mean by flat fee is that you know exactly how much you're paying in a dollar amount every year. It's not based on asset size. It's actually, for me, I love the idea of advisors being so clear. We should probably go more into this in a minute about the who do you serve and how do you serve is the first two questions you have to ask. But I would love for advisors moving forward to be so deliberate about who and how they serve that they're able to charge every household the same fee for the same service and process, whether with investment management or without. So I refer out, but I will not refer to an AUM advisor at this point.
So if a client, a potential client comes to you and they already have that relationship, or they have somebody that they want to work with, how do you handle a situation like that?
So I actually do work with a lot of clients who have their investments managed by another advisor, and they come. Most of the times, this is what happens: is they come to me. We do the comprehensive financial planning engagement, and then they go, "Wait, why did I just pay you $6,400 to do all of the work, like all the things that I actually wanted out of an advisor in terms of when do I claim Social Security, like tax gain loss harvesting, what should I sell, what should I buy, what are my like true expenses in my investment accounts, not the 1%, but like what are all these other funds that I always talk about investments and fees in a dollar amount. That's one of the biggest issues with our industry. We talk about 1%, but nobody talks about like, oh, like, how much do you pay for your mortgage? Oh, I pay 10% of my gross income toward my mortgage payment. Like we don't pay for things as a percentage of our income. Probably another debate. But I'm really very transparent about them understanding like what they're getting, what they're paying. I never talk poorly about the other advisor, but when I go through a truly comprehensive planning process, cover 25 topic areas, right? So out of the 88 topic areas I cover in planning, only 5 of them have to do with investments. They say, why did I just pay you $6,400 to do all the work? And I'm paying this guy over here $30,000 to do nothing, because they're not, again, we aren't normal. We aren't the normal people in this room, but the average advisor is still charging 1% AUM to only manage investments and not do comprehensive planning. So their version of when they say they do planning, but planning to them is saying, hey, like, let me see your investment accounts, because that's all, like, really, they're only doing the work that makes them more money. So, hey, if I review your investment documents, I can get a really good idea of how much money I can move under management. They're not looking at tax returns. They're not looking at employee benefits. They're not looking at insurance policies unless they're able to sell them another one. So again, this is my soapbox is that the average advisor is still trying to do the least amount of work for the most amount of money, rather than doing the right work for the right amount of money. So I encourage all advisors to understand, before you even determine how to charge clients, you have to understand whom do I serve in as much detail as possible. Who am I serving? Then how am I serving them? How am I providing value? What's my process? like what does financial planning look like, or is financial planning even my service? And then only then can you determine what's the most, not how should I charge, but what's the most appropriate way for the people I serve to pay for the service I provide. So I think that Drew and I would most likely agree. We kind of keep coming back to it, that your fee model is not the first decision you make when you go into business. It's the last decision you make once you understand exactly who you're serving and how you're serving them.
And
well, I was just doing a little bit of math
Drew.
because I take issue with this, some of this too, like to your point of those people that are paying 30,000, 20,000 or north of that a year. I mean, just divided by, let's just say $500 an hour, it's basically 60 hours a year that that advisor is, putting in, or 5 a month.
They're probably doing 5. I think that's the average I've gotten from other advisors.
So I do hope that conversation changes because, because some people will say, well, you're doing the same amount of work for a $3 million account as you are a $300,000 account. I don't think it's that easy. I think it depends on who you're taking care of, what they're hiring you for. Mm-hmm. But to your point, like some of these fees are just getting a little bit out of hand for the level of work. And, you talk about regulation on commission versus fee. There should be something going on there too, in my opinion. But yeah, to your point, you've got to start with who you're going to serve. And then to your point, I really like your point about the service model versus the fee, because that kind of gave me an aha, because, and I've always done the same thing. Like back in my days, we would give people, hey, it's 1.35%. And then the firm finally caught on as I was leaving to print it out like in dollars and cents. I would always calculate the math.
For example, right.
Yeah, exactly. And then because a lot of people can't think that quick in terms of percentage, especially if there's a point something like a 0.35 or a 0.75, 1%. Sure. Most people, but not everybody. And it makes it more real too. It's 1% on 500,000, or it's, this is going to be $5,000 to $6,000 a year. And I think, we're well compensated for what we do. I think a lot of people are selling themselves short. But yeah, I think putting it in terms of dollars and cents so that they have the understanding of what it is, because go ahead.
Sorry, I'm just excited about this. So AUM is not just like going away from like the percentage of assets, the way clients pay that AUM is one of the biggest issues for me, because the way people are paying AUM straight from their investment accounts is just like how people pay taxes from their pay stub. So if everybody had to send a check to the IRS for their amount, if everybody had to pay quarterly tax payments straight direct to the IRS, like actually signing a check rather than having it withheld from their paycheck, like our nation would have, like, it would be like an uproar. When people realize how much they're paying in taxes, people would actually change, like legislation would change very quickly if people actually knew what they were paying. And one of the biggest issues I have is that when I talk with an AUM advisor, I talk about, they go, yeah, like, they're like, I'd much rather go like, flat fee than AUM, but AUM just like, it reduces the friction. Like I literally heard from AUM advisors, even who do financial planning, they say, but what I love about AUM is like, it comes straight out of their accounts. Like they don't really know what they're paying. And these are people who are not just fiduciary in letter, but they consider themselves fiduciary in spirit, are saying things like, the reason I keep AUM is because it reduces friction, right? Our job is not to, again, you talk about, yes, they're still fee only and they're transparent about the fee, but there's a difference between like the transparency and the saliency about like just telling somebody, putting on the bottom of a statement what their fee is versus actually communicating that and actually making sure they understand the fee. Again, like most people just, they go, yeah, 1%, that sounds really cheap. Years go by and only at a certain point are like, well, I charge I'm taking 4% out of my portfolio per year, and I'm taking another, like you're my highest, like people are paying more for their advisor than they're paying for their retirement lifestyle sometimes, which is crazy to me. It's, or like they're paying their advisor more than they're paying their the IRS in retirement.
Well, it comes down to value. There's value is what really matters at the end of the day. And I've talked many times about my previous experience working as a financial consultant, discount brokerage firm, trying to help clients, trying to give the same advice that an advisor would give. I always talk about 08 and 09. And I just remember, kind of like what we're dealing with now, watching the market go up 1,000, down 1,000 day after day, and watching clients make, in my case, I saw people make just monumentally bad decisions, but they weren't paying for the advice that I was delivering. And so the value, Cody, what you're doing in terms of, providing value to those clients and then justly being compensated for it, they have buy-in, they're part of it.
Yeah.
Where, I looked at, some of the experiences that I've had where, again, it's the same advice, but the clients just didn't, there wasn't the buy-in there. And then you see people fall out. So that's where value comes from.
I would quickly say that I think the biggest issue, I think that when, I don't want to have a debate with you too, but I just say that advisors shouldn't charge for value, right? Because value is the consumer's perception. Like, for example, when you go to a restaurant, you don't pay, you don't pay based on how much you enjoyed the meal. So like value to me is, we can't define value for a client. The value is perceived by the client and the service is provided by us. So like, I really don't think that when advisors say they charge this way because, it provides a lot of I charge this client more because I provide more value for them. I have to question, what does value mean? Because the value, I would love for advisors to are you going to quantify that value? Like, is the value that, the $2 million account versus the $1 million account, they will tell you in some cases I'm providing 2 times as much value. It's but what is 2 times? Is it 2 times the tax savings, 2 times is it quantitative? If it's qualitative value, that I just don't understand how we as advisors can define that value, since it's ultimately up to the client and what the value is.
And no question, it's challenging. But that's part of what we're trying to do in terms of just turn on the lights, transparency, and focus on what services are being delivered, cost, and to your point, it's different for clients as far as what they perceive to be value. But yeah, this topic we can get into, we can go for hours and hours on a lot of different ways. So we're going to finish up this portion of the meeting. We're going to let folks into the room from the group now to have a bigger dialogue. If you're part of the GAF Peer Pod, please join conversations this week. Please join us on Wednesday in our Hear from a Peer Roundtable. We'll be discussing this again. Friday, the GAF live session, LinkedIn live stream, we'll be getting into this topic as well. So if you're a member or not a member and you'd like to engage, please do so. Cody and Drew, thank you both for joining us this week. We will be jumping into this conversation again, probably many times in the months to come.